The best of Bloomberg Intelligence. Ira Jersey, of course, puts out this chart maybe a day or two ago. And I think what's interesting, Katie, especially when we think about the bond market, sort of the big impacts. We've talked a lot about the impact from midterms or the election. Here, though, the debt ceiling. And I think what's interesting is that note really talked about how the Treasury Department has about $830 billion of borrowing capacity under the debt limit. But we could start to reach that starting at the end of the fiscal year 2023, heading into fiscal year 2024. So how do we think about that big event and the impact on our world of treasuries? Let's get more perspective on this with Ira Jersey, Chief U.S. Rate Strategist here for Bloomberg Intelligence. I stole your chart, took it from myself, published it under the terminal for all to see. What do you make about the debt ceiling? Something we really haven't talked about maybe since about that 2011 time period.
Yeah, it's been pretty nice, actually, not having to worry about the debt ceiling the last couple of years, because it's the dumbest debate that Congress has, quite frankly. I mean, so they don't talk about how much they're going to spend. They don't talk about how much they're going to tax. They just talk about whether or not they're going to repay the bills that have already been accrued by the government. But it is what's interesting about this, Taylor, and why the midterm elections this year might matter for this is that we're already very partisan. We could get more partisan if the Republicans take control of one house of Congress or the other or both. You could have another debt ceiling standoff kind of right at the beginning of 2024, and that might be the last time that members of Congress have a chance to kind of lay in their spending plans in particular and their kind of primary goals for the deficit before the 2024 presidential election. So I think we could have another contentious debt ceiling crisis. It's still a long way away, right? It's still a year and a half away, but it's still something that's looming out there on the horizon, something we have to worry about.
What's a little bit more close to home in the midterms, and I'm interested as to whether that has any issue, do you think?
The midterms in terms of...
Well, I mean, what are you thinking in terms of more a build towards political anxiety as we look towards coming up against this debate that we continue to have? Are you thinking more about the Federal Reserve as the more focus point for you right now, and how does that sort of look into the near-term future?
Yes, so I think really the midterms could affect certainly markets and the Treasury market a little bit, particularly if we have stagnation. And interestingly, risk assets tend to like the government not doing anything because I think there's a certain amount of uncertainty. But really, you very rarely have big moves in the Treasury market during midterm election cycles. And in fact, the only two times that you've had in the last 25 years or so any big moves were in 2002. When the market rallied a lot because interest rates were going down because we were heading into a recession after 9/11. And then in 2016, after Donald Trump was elected, you wound up getting a significant sell-off in the bond market. But those really were the only two times that you saw significant moves. And other than that, it's really just been noise. It's been almost like day-to-day normal volatility in the market. So the markets look past that. The details, though, will matter because if we do get more, say the Democrats retain both seats in both houses, it's possible the deficit will be slightly larger because typically when you have one-party Congress and the presidency, deficits tend to be a bit higher than when you have split government.
Ira, I love what you said, that the debt ceiling debate is the dumbest debate that Congress has. It's a big call. But I do want to switch gears pretty dramatically here and talk about the yield curve, because I'm looking at the 2-10 spread right now. It got below negative 49 basis points earlier today. It's bumping around there. And at this point, we're at the most inverted levels since 2000 or so, maybe even further. And at this point, how far can this inversion go? And would the Fed start to get worried about this at any point?
Yeah, I think the Fed kind of anticipated that this was likely to happen, just with the idea that they're going to be raising interest rates to fight inflation now. They want inflation to be lower later, so that means interest rates should also be lower in the future. So you're going to see some inversion of the curve. Now I do think that we'll get even more inverted, probably to maybe negative 65 basis points on the 2s-10s curve. One of the reasons for that is really I think that the market's still mispricing how far the Federal Reserve is going to hike to. So I do think that they're going to hike to above 4%, which means that two-year yields are probably mispriced by between 40 and 100 basis points, depending on how far the Fed goes. And I don't think that 10-year yields are going to go much past where they've been over the past couple of months. So you could see really a continued flattening and deeper inversion of the yield curve.
Does duration of the inversion or magnitude matter more to you?
Yeah, probably. That's a good question. Probably the duration overall, because if we stay inverted for longer, then that's probably signaling that the market is really thinking that that we're going to have a more significant slowdown later. Whereas if we get if we touch like negative 80 basis points or something like that, that's probably just noise and intraday volatility, a lot of stops getting hit, things like that. Whereas if it persists for a longer period of time, that's suggesting that the Fed is going to keep those short end interest rates and the Fed funds rate higher for longer. And that's kind of the Mary Daly statement that you heard her say just a couple of weeks ago. And if that occurs, then I think the market's going to price for an even deeper recession.